Welcome to the Nichols Tax Update. This program is made available to you as a member benefit by the South Carolina Association of CPAs. It is produced to provide current information about developments in United States tax law, cases, rulings, IRS pronouncements, and expert comments on hot topics. My commentary is necessarily brief, and you should consult appropriate authority before taking a position on any item discussed in this weekly program. Our first item raises the question of whether a loss is a capital loss or an ordinary loss. A loss incurred from the disposition of an asset which is used in a trade or business can be an ordinary loss. A loss incurred on an asset which is held for the production of income is going to be a capital loss. It's the difference between Code Section 162 and Code Section 212. In our instant case, David Keefe and his wife, a decision of the Second Circuit, a doctor and his wife purchased a historic mansion in 2000 for $1.35 million. The plan was to renovate it and rent it out. They borrowed over $9 million for the purpose of doing that. They began their plan of renovation, 22 rooms, and began to advertise. But they didn't advertise very much for rent, and they advertised a whole lot for sale. All of the advertising from about the second year on were for sale, and the price was adjusted downward 4 different times. It was never rented. Never, ever. Finally, it was sold for a substantial loss. The taxpayers discovered, after they had filed their initial return, appropriately claiming a capital loss, that they might have filed a return claiming that this was a trade or business loss, in which case it would have been fully deductible with losses that could be carried back and carried forward. So they filed the amended return. The IRS audited the amended return. The tax court said, no, the taxpayers were mistaken. Their renovated mansion, which was never rented and which was offered for sale again and again and again, year after year, was not a rental property. It was bought, fixed up, and sold with an intention to make a profit. The loss is a capital loss from the sale of investment property. Next, just news about the Office of Professional Responsibility, the OPR. They have a new director, Sharon Fisk, who, by the way, is an attorney. This has been, over the last couple of months, been a lot of information coming out about how the OPR is going to be organized. She reinforced in late July that they're going to create a new enforcement officer position. They are phasing out attorney positions, but that's sort of, I'll explain a little more about that in a minute. They're still going to employ attorneys, but they will not work as attorneys in the IRS hierarchy. It's the difference between a 930 job series and a 905 job series, and probably has something to do with their compensation. It's a matter of title, according to Ms. Fisk, not education and experience. Okay, we haven't dealt with them yet, so we'll see. They're also increasing the staff, 5 new enforcement officers and 3 clerical staff. That probably means that we can expect to see increased enforcement activity initiated by the OPR, rather than simply following an action initiated by a state board of accountancy or perhaps the AICPA. The OPR is going to be the original complaining agency against some practitioners who fail to exercise due diligence, who are playing fast and loose with the rules. Well, my suggestion is, if you're not carefully monitoring how you follow the rules in the AICPA statements on standards for tax services and the rules in Circular 230, I suggest that you revisit that and rededicate yourself to an ethical tax practice. Next, individual foreign tax credit. A puzzle. We don't do a lot of those, but they do come up. So the IRS has created a practice unit, which is a guide. The citation is INT P218 on July the 2nd this year, they released this 14-page printed guide, which could have about 7 of those pages could very easily be made into PowerPoint slides for purposes of creating our training programs. In any event, this is one of several practice units developed by the IRS to train their auditors that are made available to us. You can download them at www.irs.gov. This one explains preparation of the Form 1116, the foreign tax credit for individuals, estates, and trusts. This training document, explains 4 steps to calculate a credit. It provides an example and lists considerations and resources that will be important for the individual learning how to calculate the credit. Read staff training tool here, right? Only 14 pages. It's a perfect training tool. Next, the QUIP bonus. What a dog's breakfast this has been. Qualified improvement property was overlooked in tax legislation, and so it did not qualify for 15-year write-off. It didn't qualify for bonus depreciation. It didn't qualify for the 100% bonus, which was a big deal. So Congress went back and fixed it retroactively. So we do have special tax rules that apply to qualified improvement property, mainly that you can write off the cost 100% in the year of acquisition. So it's important. In this particular item, the taxpayer buys an empty apartment building. So here's what several different IRS personnel said. This just summarizes all of their remarks. The example is a taxpayer buys an empty apartment building and incurs expenses to convert it into a hotel. The apartment building was residential property, without a doubt. The hotel will be non-residential property. So expenditures to convert the apartment building to a hotel will be qualified improvement property. QUIP property will be eligible for a 15-year recovery period if bonus depreciation does not apply. The point being made here, it is the current use, not the former use, that is key to qualifying property or improvements to property or additions to property as qualified improvement property for purposes of bonus depreciation. Protecting client tax data. The IRS has been on this like a duck on a bug for at least the past 12 months. We've talked about it in these programs again and again. Here, the IRS expands on publication 4557, Safeguarding Taxpayer Data, by publishing 6 steps to protect tax data. Information release 2020-167 on July 21st. Those 6 steps are: you should employ antivirus software using automatic scans and occasionally perform a manual scan, especially do manual scans of incoming documents. Don't just download a document, even though you might trust the source. Scan the document before you load it into your system. Use firewalls. Use a hardware firewall and software firewalls. There's a hardware software. You can buy that. It's a device which plugs into your network. Software is features that are in most operating systems, so you have double protection. Use 2-factor authentication. Use more than a password. Use a phone call to a cell number to get a key, a 5-figure or a 6-figure numeric code. So you need more than a password to get into some critical areas. Encrypt your drives. Your main drive should be encrypted, and then every person that works outside the office should have a virtual private network. Those who travel, and as I do, I do research, and sometimes will write a tax opinion in a hotel room. I always set up my virtual private network. I don't just log in to the hotel's internet. Next, Fact Sheet 2020-11. This fact sheet outlines reporting obligations for large cash transactions. Didn't we already know all about that? Well, obviously the IRS doesn't think so. They're going to begin an enforcement effort, and so they want to make sure that they tell us well in advance of that. They want to remind us what the rules are. Who must file the Form 8300 for a cash transaction in excess of $10,000? What is cash? Obviously, currency is cash. Cashier's checks are cash. Money orders, those are cash. Reporting cash payments are illustrated with 5 examples of businesses that commonly might receive cash payments. When to file the Form 8300 is important. How to file it, the importance of getting a taxpayer ID number from the person who gives you the cash. And you can't tell them you're going to report the number. In fact, if you think it's a suspicious transaction, you for sure can't tell them that you're going to report the number. But the suggestion is you just simply ask for the number as though it's routine, part of the transaction, and it is. If they refuse to give it, obviously you don't have it to give to the IRS, but you must so state that and explain it. Informing your customers about the Form 8300 is also important. Your customers need to know that your business is compliant and that you will file these forms when the law requires it. The IRS is relying on frequently asked questions. More and more. I'm sure you've noticed it as I have. Hundreds of frequently asked questions on coronavirus issues alone have been posted across classifications on the IRS website. My good friend Bradley Burnett, many of you have heard his work on CPE programs on COVID-19 issues, has worked a lot with these frequently asked questions on COVID issues. 94 of them are on the Employee Retention Tax Credit, 93 on the Families First Act, 69 on the economic impact payments from the CARES Act, 67 on coronavirus-related tax credits, and 40 on payment and filing deadlines. The deal is that the FAQs are not authoritative guidance. And we all know that. We're doing the best we can. The IRS has not had time to go through the traditional review processes and give us revenue rulings and revenue procedures and notices. They recognize the need for some sort of guidance because we have immediate filing deadlines. So their position is, this is better than nothing. Great. Thank you very much. Until next week, I'm Lynn Nichols, and this has been the Weekly Tax Update.